Well, good morning, everybody. It's 9:30. It's the 16th of October, and today, in the latest round of PD tax webinars, we're talking about the tax implication of corporate deals. When I mean corporate deals, what I mean is the sale of shares in a company, not trading assets, purely the sale of the corporate itself. This is a subject that all the participants voted for in the last seminar that we held. So my name is Paul Davison. For those who don't know me, I am the Director of Business Taxes in West Yorkshire. Director of Business Taxes for PD Tax Consultants in West Yorkshire. I've been doing tax for a long time. I'm well qualified, and today I'm assisted, as always, by Amy. These slides do not constitute advice. So the usual type of thing, your mics won't be enabled at any point, so you can relax. You don't have to say anything. But please send your questions as soon as they come into your head to Amy via our question and answer session on the Zoom facility. Get the questions in as soon as you can, because there's probably going to be a lot of questions and we want to get your questions answered. But if we don't get them answered, we'll be in touch with you after the seminar to talk to you about them. There's a poll in the middle as normal. Yeah, I've mentioned the last one already. So the nature of the webinar, I'm going to be looking through the main tax items of corporate deals. It's going to be pretty succinct. And as ever, you might not understand all the points, but hopefully you'll take at least one thing away from today, which you can use in your work going forward. So without further ado, this is what we're talking about. Corporate deals. These are the items that I'm going to cover today. It's really just a sort of a menu of things that I've worked out through experience that you need to think about, go through them one by one, make sure you're happy with them. So we've got the consideration for the deal, we've got the application of entrepreneurs relief, we've got the substantial shareholdings exemption if it's a company that's selling, we've got earnouts, quite a tricky area, we've got the tax covenant, also known as the tax indemnity, we've got tax warranties, we've got dealing with outstanding loans, and we've got structuring a deal. Apparently my microphone is playing up a little bit. I'm not sure why, but I'll have to keep going, I'm afraid. So the consideration for the deal. Section 3 of an SPA is generally, Section 3 of the SPA is generally where the consideration is detailed for the shares. So SPAs tend to be structured in the same sort of way. So what I tend to do is, Section 3 is the most important section, but you need to read Section 3 in accordance with Section 1, which is the definitions and interpretation. You also need to record it for the sale and purchase, which is Section 2, and Section 4, which is the completion of the SPA. And the consideration, obviously, is the amount of cash or other assets or whatever, which is to be provided in exchange for the shares. Quite straightforward concepts. Then we've got the application of entrepreneurs relief and the vendor's CGT computations. So we all know that entrepreneurs relief is an important relief for somebody selling, and although the actual lifetime allowance has come down recently, making it less important, it's still pretty important for most people to get down from 10%. So one of the first things to do is, if there's a number of different shareholders who are selling, you need to identify those who will qualify for entrepreneurs relief. They have to have had over 5% of the shares, be an officer or employee of the company, and not used the lifetime allowance. Obviously, the company needs to be a trading company as well. Or potentially they could have got their shares through an EMI scheme. And if they did, then the 5% threshold doesn't apply. So yeah, make sure you identify who's going to qualify. You don't want to be telling people that they're going to qualify for entrepreneurs relief if they don't qualify. That is setting everybody up for a fall. And another pitfall here is that for those who do qualify for entrepreneurs relief, make sure they don't resign as a director or employee until the day after the shares are sold. If they, just a message from Amy, if they do resign the day before the shares are sold, then actually the entrepreneurs relief could be stymied because they have to qualify on the date of sale. And the advice is really always prepare an illustrative tax computation for each individual that's selling, which involves obviously working out their proceeds, identifying what the base cost is, not always straightforward, and then working out the tax rate. Tax rate could be 10%, it could be 20%. And also factoring in any earnouts into that tax computation. So we'll be coming back to earnouts in a while. Okay. Next slide. Substantial shareholdings exemption. This is really only applicable if the vendor of the shares is a corporate. If you've got a corporate selling another corporate, the qualification of the substantial shareholdings exemption is a pretty important. Sometimes you have to decide, obviously, what you're going to be selling, because sometimes it's better to sell Topco rather than selling a subsidiary out of Topco. It depends what Topco is doing. If Topco is a shell, it would tend to be better to sell Topco rather than the subsidiary out of Topco. But if we are selling, if the Topco is selling a subsidiary, do we qualify? I'm not going to go through the conditions here, but we know that a few years ago they were relaxed, meaning that actually a lot of disposals these days will get substantial shareholdings exemption, primarily because of the changes where the vendor co used to have to be a trading company afterwards. It no longer has to be a trading company afterwards, which gives more deals a chance of qualifying. But what we suggest you do is, every deal you've got to check through the detail and make sure that you do qualify. And what does a corporate do with the money after the deal is done? Well, that depends on the situation. You might try and liquidate it. You might be used within the group. That's a slightly different discussion. Okay. This is probably one of the chunkiest areas for today's discussion. It's really quite a tricky one. Needs some thought. So, do we have deferred consideration, or do we have an earn-out? So, deferred consideration is where effectively there's a delay in the payment of the consideration. Now, there could be a delay, but there's also potentially the ability for that amount of consideration to change. And for example, what tends to be the case is that if it's ascertainable at the date of the disposal, then that will be treated as being deferred consideration, and it's taxable up front. So that type of thing will qualify for entrepreneurs relief. Whether it's ascertainable or not is probably dependent on the fact on the actual deal, and whether the factors were in place at the date of disposal or not. If the factors weren't ascertainable at the date of disposal, then it's more likely to be unascertainable. So if you have ascertainable consideration, you work out what that consideration is, and then you tax that as a normal consideration, taxable at the date of disposal. If it turns out for some reason some of that consideration is not payable because the factors were estimated incorrectly the date when you did the tax computation, then what you will do is you would still pay the tax on the full amount, but you'll get a refund in the tax return when it becomes clear that you won't get the full deferred consideration. If the deferred consideration is unascertainable, i.e. it's not deferred consideration, it's an earn-out, that's a slightly different type of arrangement. So what you have to do is you have to actually work out what the earn-out is currently valued at. So what we're saying here is that the earn-out might be, say, based on a percentage of the turnover over the next 3 years. Clearly, at the date of disposal, we can't really work that out what that is. So we have to work out a value based on the factors that exist at the current time. And the current value of that earn-out is subject to tax as if it was consideration for the shares. And that initial valuation will be subject to entrepreneur's relief. But if we receive more of our, if we valued the earn-out at say £1 million, but we receive 2 million for those shares, then the £1 million excess over the of the £2 million over the £1 million will be treated as a disposal of that right when you receive that money, and that won't be subject to entrepreneur's relief. It'll be taxable at the date of disposal. So the date of receipt of that £2 million at the tax rates that are in place at that point. Okay. Also, an important point in relation to earn-outs is that if you have an earn-out where, say, 2 people are staying in the business, but 1 person's leaving, and 2 people have the earn-out, that those 2 people staying have the earn-out, but the 1 person who is leaving doesn't have the earn-out, and there's a question mark as to whether the earn-out for these 2 people is for services rather than for shares, and is that subject to income tax? That's a tricky situation which needs to be looked into. Every case is different. What we're trying to do really is we still want to have the same value of consideration, but we might want to try and value the earn-out and take it off the initial consideration for the 2 that are leaving. So they're getting the same amount of consideration, because that's a key test in deciding whether it's income tax or not. Okay, well, sort of halfway through there. I need to do a poll. Here's a poll here. When it comes to communicating with our clients about a deal, is it generally the case that 1, they tell you they are signing a deal tomorrow, or even they sold one last week? We've planned for this moment together in terms of building the business and considering the tax implications. They've just got me involved with tax warranties, but I didn't know much about it till then. And some clients involve us and some clients don't. So I'm going to run that poll now. See if you want to vote on that poll. We usually have some music, but I can't find the music on the screen for some reason. So we've got 30 seconds to vote. Was it a yeah. Three, 2, 1. Right. Thank you all for voting. And we'll share the results of that poll on LinkedIn and Facebook after this session. Okay, moving on from the poll. There's the music. Anyway, okay, so on to the tax covenant now. So the tax covenant is a situation whereby part of the SPA, it's a schedule of the SPA, which tends to be included in the sale and purchase agreement when there's completion accounts. You might understand that completion accounts sort of amend the value of consideration depending on how the sort of balance sheet moves. Tend to set a target for the balance sheet, and if it moves from that when the completion accounts are finalised after the deal, then the consideration is either upped or reduced depending on how the balance sheet is moved. So you can see from that the tax provision in the actual completion accounts would be the sort of starting point for a tax covenant. And the tax covenant effectively says that if anything happens, if it becomes clear after the completion that more taxes become payable, say through an inquiry, or say because there's been an error in a tax return form, or there's been a claim which has been wrong, then through the tax covenant, the buyer can claim back monies from the vendor through tax covenant. So obviously they would have to understand what's been included in the tax provision and then say, well, actually, we think this £5,000 bill, because of the error in the R&D claim, wasn't provided for in the completion accounts tax provision, so we're going to claim that back. Quite a normal thing, just needs to be checked through generally, make sure it works. Sometimes there's like a de minimis to think about, and that if you was advising the vendor, you'd probably suggest a de minimis, because you don't want them claiming for £10 here, £100 there. And it tends to be the case that if there's an under provision in the tax, then actually, sorry, if there's an over provision in the tax, then the seller doesn't get any money back. So it's important to sort of get the tax provision as close as you can, really, in the completion accounts. Okay, tax warranties. Tax warranties are important because the buyer is buying the company. So they're by de facto, they are inheriting the tax position of the company. So they want some comfort that you've done. If you're the vendor, you've done as much as you can to get your tax position right, and there's nothing that's going to sort of stick its head up in a few years' time. So what happens is the vendor is asked to make some statements in the sale and purchase agreement about the tax position, which, if these statements are found to be untrue, could give rise to a claim for damages by the buyer against the vendor. And there's tends to be what tends to happen is, I think the vendor tends to set up the SPA to start off with, and it's the buyer actually sets up the SPA, and they want a load of different as many tax warranties as possible. But obviously the vendor doesn't want to give tax warranties as possible, wants to give us as least warranties as possible, and we don't want anything that's not relevant. So it's important to go through a tax warranty, decide which ones aren't relevant, agree that, take them out. So an example of a tax warranty might be the company does not own any chargeable intangible assets as defined in Part 8 of CTA 2009. Not quite sure why I chose that one, but I did. And it's important to know that if there is a warranty, and it's a relevant warranty, that what the vendor can do is they can disclose against that warranty in a disclosure letter, which gives. So if they can't particularly give that, so for example, if we could give that warranty, that one there about chargeable intangible assets, but if we did hold an a chargeable intangible asset, we would have to write that in the disclosure letter, and we'd write something like, the company does not own any chargeable intangible assets except from blah 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 and the details of this. So we're not telling any untruths. So the disclosure letter effectively protects the vendor in a position where they can't fully give the warranty. A couple of sundry points. So one of the sundry points is to consider whether any MI schemes are coming to fruition on the vendor side. So sometimes, quite often, an EMI scheme is set up by the vendors during the lifetime of the company to incentivize key staff that on the disposal of the company, they will get shares. So this is the time that's going to come to fruition. Make sure you've got all the ducks in the row there. The paperwork's going to come under scrutiny at this point, so it's important it's right. And think through the implications clearly of that EMI scheme coming to fruition. One of the ones which is sometimes missed is that the employer has to pay employers' national insurance on the exercise of the options, because by definition, the EMI holders are getting shares and immediately there's a market for them. So that means they're readily convertible assets, which means that the company is due to pay employers' national insurance, and that'll probably be payable after the deal's done. So it's going to come out the buyer's pot effectively. So we need to understand that and deal with that. We know that due diligence is going to be difficult and nitpicky, so make sure, you know, before you go into it, you got all your ducks in a row, all the paperwork's right, any tricky company's house things are all dealt with. Will the vendors get any share options in the company, or will they keep working for the company? Sometimes what we're saying is that even though they're selling all the shares, if somebody's staying on, there could be a situation whereby they're going to actually get some share options, or they're going to keep working, so they're going to be employed. So make sure that's all dealt with. You know, it's a separate exercise to the sale, but it does need to be tied in, and you need all your paperwork, you need your employment contract. We need to make sure that employment contract is on an arm's length basis, so there's no dispute as to whether those payment for services is going to be mixed up with the consideration, all that type of stuff. I did have a slide about loans as well, but I think Amy seems to have stripped that slide out for some reason.
Don't blame me.
There's a slide about loans, which was basically saying that if the shareholders are owed any money by the company during the company, then obviously the buyer can pay those loans out. It's a very tax efficient way of getting money, because effectively we're not paying any tax on getting that loan tripped out. Also, if the directors or shareholders do owe any money to the company prior to disposal, then what can happen is that the buyer will say, well, actually, we'll pay you for the shares, but then you've immediately got to give some of that consideration. The company will then pay, you need to pay that back to the company to pay off your loan. Quite a tax efficient way of paying down the loan again, but needs to all be arm's length and all correct. Right, so we're coming to the end now. Amy, I heard you there. Any questions?
Yeah. So firstly, on an earn-out, if they receive less than the initial total estimate, do they go back to the tax return to amend it?
What happens is depends on what we're doing. If there is if it's a deferred consideration and they receive less than what they expected for whatever reason, then we don't amend the original tax return. We make a claim in the tax return form in which the reduced consideration is received. a claim to sort of get a refund of the original tax. If we have an earn-out, i.e. it's unascertainable, then what we do is we say, right, in my example, the base cost was $1 million. So the base cost of the right to receive the earn-out is $1 million. If we receive, say, £800,000, then what we do is we create a capital loss in the period we received the £800,000. And that capital loss, I believe, can actually be carried and set against. You don't have to carry it forward. It can be carried and set against the gain.
Okay, thank you. Another question about earnouts. How do you go about valuing an earnout? Is there a particular valuation method you tend to use?
Yeah, well, obviously it depends on the sort of situation really and what it's based on. There tends to be two sort of main ways of doing it. If it's like a sort of an option type of thing and it's a bit unclear and you've got sort of a few different market rates going on, it's a bit more of a dealt with company, then what you might do is you might use some sort of option scheme valuation model like the Black-Scholes model. But it's got a few factors which are a bit tricky sometimes. So what you could use with it instead is some sort of whereby you sort of work out the risk of failure. So you look at the terms of the earnout and you decide, how much of a stretch based on current market, based on a load of factors, how much of a stretch is that to achieve at different levels as well. And you sort of might factor in things like current profitability, difficulties in the market, COVID, budgets, all different things to decide what the risk of failure is, and then sort of factor that in to the amount you're going to receive effectively. Yeah, so there's a couple of different options, but it does depend on the factors.
Okay, have you got time for one more?
Maybe. Yeah, one more.
Do you think the benefits of Entrepreneurs Relief or SSE will be reduced in the near future?
Ooh, good question. I think Entrepreneurs Relief has obviously already taken a bit of a bash, come down from £10 million to £1 million. So it's now only effectively worth £100,000, which is a lot of money. But I don't know whether they'll scrap it, because I think there's always been something around for encouraging a disposal of a trading company, and the reason for that is because it encourages people to grow their business and aim to sell it, which generally improves the economy. So I don't know whether they'll scrap it totally. My feeling is they might leave it, because I think it does have. I think it's one of the few reliefs that generally does affect entrepreneurs. They genuinely work towards entrepreneurs relief, getting entrepreneurs relief as a target. So I don't think they'll scrap it. SSE, I think it will be very controversial to scrap SSE, because I think a lot of European countries have got it, and I think they're more likely to put the corporation tax rate up than scrapping SSE. Could be wrong. It's only been in for 20 years, SSE, so it's a relatively new relief, but I think there'll be uproar with big business, especially because big business are the people who tend to utilize it, and I would doubt they would scrap it. But that's just my view. Don't hold me to that, please. Okay, thanks, Amy. It's now coming up to 10 o'clock, so I hope you all have a nice day, and I hope you've learned at least one thing from today's meeting. Thank you, and bye.